right. Welcome back, y'all. Issue 19, which is wild. That number's starting to get up there. For the love of the game, acquiring and operating Micro SaaS. This is Kjael, and I've got my boy Kjael, the Wiz, whose birthday is in 2 days. How you feeling, Kjael?
You called it out. I feel pretty good, man. I still feel, what is it now, 32? I'm turning 32. I feel like it's the new 22. I'm feeling young as ever. Um, I don't know. I'm not having any like serious celebrations. Most of my celebrations are traveling. So I got a chance to go see my boy Drizzy Drake. Now I'm gonna go hug a tree in Seattle in 2 weeks. So that's my kind of celebration.
Cool. Any gray hairs creeping into the beard, or not even close?
Oh, dude, listen, this isn't cracking anytime soon. You got another 20 before that happens.
Oh, good. All right, well, let's jump in. So we're kicking off here. Let me just pull up the agenda that we got cooking here.
A nice off-market analysis.
That's right, buddy boy. So we got some big stuff here. So issue 19, boom, kicking it off per usual with a deal teardown. So just to give you a sneak peek of what's coming over the next 4 weeks, we've got the deal teardown shipping right now. We're going to be looking at an off-market deal. And a lot of micro acquisitions is a function of companies that are listed on marketplaces, et cetera. So this is a big change of pace for us. We're working with way less data. And this deal is definitely out of our wheelhouse. This would be falling kind of square in the lower middle market, buyout, more conventional private equity profile. But needless to say, we want to build muscle around that. And this was a really good candidate that a buddy of mine passed along. He's like, yo, this looks like some niche software. I was like, high five. Indeed it is, my man. Thank you for thinking of us. And then part two, we'll change gears and head into an operating concept. And I guess with that, that's going to be a little bit of a different flavor too. A lot of the operating concepts that we share are from the perspective of operating a business, a SaaS firm. This one is more through the lens of operating a fund or being a private investor. So we'll just look at the flavors of a private equity investment. I hate thief. I got to get my Mike Tyson on. Like, Merry Christmas.
Yeah, let's hope he doesn't hear this.
That's it. I no black eyes for me. All right, and then we'll jump into an OKR teardown where we're going to be talking about executing a UGC tactical experiment. So we can just think, right? We were rocking webinars. We've got a pretty well established ambassador channel. So now we want to continue to test channels. We've got our always on buzzing with our blog, with the ambassador program. We've got a really engaged Facebook group community, but we want to continue to test and make sure that we're, kind of allocating our energy and our resources accordingly. So we got some surprises cooked up there, and then musings per usual, TBD. That's just the chaos going on between my ears, but stay tuned for that part 4. Sound good? Issue 19, baby. Let's get it. Yeah. What's DJ Khaled? We the best. I'm like, we know. We know, man. We know.
Oh, look, a teardown. Another one.
Another one. There you go. All right, cool. So there's a quick disclaimer at the top of the deal teardown, basically articulating everything that I just mentioned. So this is an off-market deal, meaning they have no intent to sell. There's no visibility into what are conventionally proprietary metrics like revenues, customers, LTV, churn, all the stuff that we would have to look at eventually to do a deal. But this is a well-established firm providing estimating and scheduling SaaS for countertop fabricators. So, man, the riches are in the niches. This is niche vertical software. And the headline reads, profitable SaaS with 896. Oh, no, I need to update this.
Yeah, they're trailing 1200, a lot bigger.
Yeah. Oh, I need to update this. Sorry, this is not accurate. Give me 1 second and I'll pull this up real quick. Forgive me, y'all. Man, I'm glad I looked at. Geez, I just forgot to update the firm profile. At least that's a first. I don't feel like a total knucklehead.
The first thing I looked at were the bullet points when I went through this. I didn't even notice.
Yeah,
that
it's funny. You
line
just
there.
almost skip over that, right?
Yeah, because the bullet points are just like right there. It's like, yeah, snackables.
It's like, bang, here, forgive me. Give me 1 second. I'll pull this up and we'll let it rip. Cool. So specialized software solutions for the countertop fabrication industry, addressing critical jobs to be done, such as estimating, scheduling, and job management. They have 2X products in market that streamline the process of drawing and estimating for quick, accurate quoting and managing the scheduling of jobs for increased shop efficiency. A notable point of differentiation for them is its targeted functionality for niche market, as we've noted, offering deep industry-specific capabilities like QuickBooks integration. Obviously, it's web-based, and those are, I guess, typically not found in more conventional, generic construction management software. That's where the horizontal players are. These tools are designed to improve accuracy, reduce costly errors, and enhance overall biz communication. They've got an estimated 1,400 users and an ARPU of $100 to $220 per month. So that's what that should say. So now let's jump into the headlines here. So asking price, unknown, right? They're not asking for a price. They're not trying to sell the business actively. Trailing 12-month revenue, we can deduce. So there's a lot of assumptions here at play. We're going to say it's 12 million. And that's basically a function of pricing plans or ARPU. So just kind of crude math. Estimate of users times an ARPU should get you within probably a 20% range of accuracy for trailing 12-month revenue. Revenue multiple not applicable here. Trailing 12-month profit, we're just going to apply kind of conventional lower middle market profit margin benchmarks, which has them at about 45 million. Has them at 4 million. They got a team size of about 25. Who knows what the product stack looks like? Growth totally unknown. And they were founded, I think, 2015. I need to update that as well. So this SV scorecard average, and again, typically we're working from what is like a teaser or a sim from a marketplace. So we have all these bullets filled out, right? And we can do way more diligence to get with public information, right? There's nothing confidential here. This is not like a private data room or anything, but we can get to a scorecard. So ours is a 2.6 out of 4. Not bad, but again, the caveat here is it's based on very limited information. So there we have it. Sorry that that's not accurate. I'll polish that up. So the industry outlook, man. So what's wild is most of the time we're looking at an industry outlook, it's like construction, like it's the actual overarching market, and it's like, okay, this software is a derivative of that market, and what does it look like? I was actually able to get my hands on construction estimating software. So there is a market size for that. And they've got it at 1.38 billion as of 2022. So sizable market, and it's demonstrated consistent growth. So it's at it was 1.28 in 21, and the CAGR is 7.93% or 8.9% through 2030, which would land it at 2.2 billion. So almost 2x growth by 2028. So, and when we think about industry growth, everything is relative. So in this context, it's like relative to GDP. So we would say this is probably 2x the growth of the broader economy. Tailwinds, baby. Lo and behold, tailwinds for us. So let's jump into trends and industry drivers. So technology adoption and manufacturing, this is pretty common. Like you can probably assume that digital transformation, obviously COVID pulled a lot of that stuff forward, but the technology adoption is active in some degree. The question we have to ask ourselves is, where are they on that tech maturity curve? Crossing the chasm is the kind of the timeless framework for thinking about that. But there is proven technology adoption, and it's growing. Customization and personalization, and you can start to see how these macro themes are so applicable. But like when we were talking about the print on demand, the days of off the right, it's like consumers have a growing tendency to expect custom products, right? So this obviously applies to home furnishings, to kitchen remodelings, et cetera. There's also another macro trend that's pretty much universally applicable. Sustainability and eco-friendly practices, like hell-bent on reducing waste. Everybody wants to get to a net neutral footprint. Obviously, software is where the work happens, is the system of record if it's done well. So that's how you prove it. Hey, we said we were going to be, net neutral by this year. Our waste in terms of manufacturing inputs has gone down by 30, et cetera, et cetera. But the software is the record keeping typically that substantiates those claims. And there's money to be made there, and there's value to be created. So we want to keep that kind of front of mind. Integration with other technologies. I had spoken about this, and it used to be, and this is just another thing, kind of evolving almost like I guess in the same conversation as technology adoption. That usually starts with, this thing hurts really bad. I'm going to buy a software tool for it. And in what case would be like accounting. I need someone to manage my books. Cool. Oh shit, I have a bunch of customers. I need someone to manage my customers. CRM. Ooh, we have a bunch of employees and they need to get paid and they need benefits. Okay, HR tech. And you can kind of see that there's a typical like step function there. And then all of a sudden you're like, but none of these things talk to each other. Ergo,
and now you have a bunch of data silos.
And there it goes from either, okay, now we need to figure out how to integrate this stuff, or you start to see platform plays come into the market, and their whole pitch is, we're going to tie together those three things that were horribly painful to manage independently, and we can compete on that. And this is a platform versus a point sales pitch, and away we go. Lastly, market expansion. She growing. I'll leave it at that. Future outlook, market growth, as we touched on, ripping, SMEs, again, kind of a global practice there, or global kind of assumption that technology penetration is happening. And then the thing too is globally that this is growing in relevance as more economies internationally, I guess, start to, the standard of living goes up, the middle class expands,
Yeah.
like the demand for custom countertops in China is probably ripping. And we could say the same in certain areas in LATAM. So that's just kind of organic growth that this software just rides the tails of.
Yeah, I mean, I can give an example of that. In my own home country, where they just struck oil in the last 5 years, and Exxon's gone in there, the entire economy's turned around. Where now the entire middle class has moved up, a whole financial social status, and construction is now booming. So real estate, new bridges, new roads, infrastructure, everything is now booming. So from a personal side, you can kind of see where some of these third and second world countries, as their own economy and their people start to live better lives, like more tools like this are definitely going to become more relevant.
Totally. Okay, so that's the category. Those are the I think net tailwinds, right? I mean, we didn't really speak too much in terms of the competitive landscape related to this software. So now we're going to jump into strengths, risk factors, and quick wins and opportunities. We'll start with strengths. So, I mean, software for custom countertop manufacturers is as vertical niche as it gets. Honestly, like this
Yes.
is one of the most niche softwares that I've come across. And obviously, there's a whole category around it, but.
But
So
think about how
this,
you feel when you see a really good custom countertop, right?
there you go, right? It's like, how did this get from the tree to my kitchen? Well, there's a whole
Exactly.
value chain there, right? So we love that. And why? Because it implies a lack of competition from venture capital backed businesses, because venture wants huge markets, niche markets can't provide those kind of, grand slam returns, and
Yeah.
venture is a function of power law, right? So they need the chance at grand slams across 10 companies in a portfolio. 8 are going to burn out, 2 are going to return the fund. Happy days. All of those economics and that whole thought process is obviously being highly scrutinized, and kind of given today's market conditions. Maybe we'll save that for another post. But anyway, super established user base. So 14,000 users, 2,000 shops. I mean, that's traction and then some. And so
Yes.
I think we can also argue that if we wanted to do some market sizing here, we would say, okay, how many custom countertop fabricators are there? Cool. 2,000 divided by that. Okay, cool. That's the market share that they've got. So we're probably talking, upper single digits, lower double digits market share.
Yeah.
Moving on, cost-effective operating model. So this was disclosed on their website that they have a fully remote team. You have to wonder, to what degree is it global? Because that's where the operating models start to change a lot. And it's very difficult to run a globally distributed software team, engineering team, just a team of any kind. Sales teams, very difficult. So there's an edge to be had there on the cost side, but there's definitely trade-offs in terms of communication and velocity overarchingly. But
Yep.
they disclose that, so we'll include it as a strength. And in our world, right, there's always two sides of the coin. It's like they don't have a global operating model. It's like, ooh, that's an opportunity for transformation and value creation. Like we can probably, capture some margin there. If they do have one in place, it's like, okay, cool. We can't execute or pull that lever, but it shows that the business can sustain itself via that operating model, right? So there's kind of validation, and I'm sure there's fine tweaks we could make there, but it's diminishing returns. And then lastly, super clear revenue model. So simplicity is mastery. If you can understand the pricing very quickly, it's assumed that that they've gotten there over time, and that it probably started as a messy, naughty thing that no one can understand. So that's all good. Did you see anything else here to touch on the strength side, Kay?
No, nothing else to touch on. I think you pretty much grasped most of it. I do see there's some upside on the global play as things become more relevant. And I do see there's some advantages as they have that global talent pool, because since depending on if they have some of their employees in strategic areas, that could be some expansion opportunities right there. So yeah, that's all I was thinking.
Love it. So risk factors, just kicking it up, potential customers. So this is all speculation, right? And this is basically like, unfortunately, it's like, yeah, well, the shit we don't know is risky. It's like, yeah, here's a cookie that was well thought through.
All the unasked questions are risky.
Yeah, but at the same time, I think it's a good opportunity to reinforce the conventional gotchas in
Yeah.
buyout, activities, right? So in this case, potential customer concentration. So we have no idea. I mean, the pricing seems standardized, but there could be some legacy peeps in there. There could
Yep.
be some, big enterprise accounts that they needed the cash flow and, whatever the case may be. But you got to be woke to customer concentration risk, because if you step in and they're like, ooh, we're cagey about a new owner, and they churn, 20% of your revenue is out the door overnight, and all your budgeting is based against kind of fully loaded revenue, you got to kind of scramble there and you're on your heels right out of the gate. And that's a terrible place to come from.
Yeah, I would actually lean into that and say it's more than likely they have some weird custom pricing involved in there, because with a software that's so niche and you have 2,000 shops signed up, you had to like bend somebody's arm to kind of get those sign up numbers, especially with having to educate so many people of, hey, what you're doing on paper does not work. There's a better way. It's really hard to get an industry of individuals who are just operating on what works to transition to something better that they don't understand, especially when it relates to technology. So you can imagine they were in there just creating like lifetime pricing or super steep discounts. Hey, try it out. And if it works after 3 months, let's decide what you want to pay us kind of deals.
Totally. And I think the piece there to kind of also mention is on the customer concentration that I just lost my train of thought. What was I going to mention? Oh, bummer. It was a good one.
Oh,
Anyway, maybe it'll come back to me. I'll give it 1,000. Oh, what was it around? Anywho, okay, cool. Well, I guess there's one thing to consider is that it is sales-led growth, which we'll get to. So it's a function. Oh, I just remembered it. Yes, was around like human-led implementation, and what they're doing. This is workflow-related SaaS. So workflows are
mm-hmm.
not like, this is not a data play. This is not an analytics play where it's like, hey, just give us your stuff. We're going to, clean it. We're going to standardize it. And then we'll give you these dashboards. This is like, hey, so tell me how a countertop gets from the lumberyard to you. Okay. And then what happens when it gets into your shop? How do you allocate staff to it? How do you track progress? How do you define the final state product? Everyone's like, you think that everybody does that the same, you got another thing coming. So it's like, all right, shit, everybody comes into this house a different way, and they walk through their house and find the way to the bathroom on their own way. So we have to figure out how we standardize that. And that was Larry Ellison's back thing. If you haven't read Software, that is an outstanding book where he's like, 80% of software at the least should be totally standardized, and you can allow for 20% to be a little bit custom, and that should be a function of implementation. But
Mm-hmm.
ideally, as the provider of software, you can almost crowdsource best practices from across your users. So his whole vision was, you do things the Oracle way, because we have a unique point of view and a vantage point to tell you what the most elite humans do to get to this outcome. Unfortunately, there's so much friction and resistance and behavior change involved in that it didn't really work out. So it's funny. His book is just like this circular thing where he would get frustrated, where like customer, and he was doing huge enterprise, huge global Fortune 500. He's like, hey, we want to change the way that you do, FP&A and billing reconciliation. They're like, no
Mm-hmm.
shot. We have to train 1,000 people on this. So anyway, but that's always been the tension of software, especially workflow-based software, which is definitely a specific domain.
It's
Cool.
funny you mentioned that. Shameless
Yeah.
plug. Side project called Sales Leverage. It's an enterprise sales workflow mapping solution where a company like this can sit down at one of those shops and say, let's map out all the steps of your workflow. How many people are involved? How many hours does it take? Now let's quantify that hourly rate to have all of those people involved, total estimated cost, and then let's map out our cleaner process side by side with that and show you quantifiably how our solution improves your time and saves you money.
And that's the holy grail, is a hard ROI, right? Because most of the time it's like, oh, this
Coming soon.
software's, it's like most of the time, and dude, plug away. But most of the time software, it's like, hey, this is going to save you time. And the worst reaction to that is like, well, then what do I do? And it's like, oh shit, like you might have just got automated. On the other side, though, it's like, yeah,
Map the
I don't
workflow
care.
side by side.
Yeah, like I don't care about this soft ROI. So if you can demonstrate a hard ROI when you're pitching SaaS, it
Yep.
makes the whole conversation with the inevitable conversation with the CFO and procurement a lot easier. All
Yep.
right,
I'll show you the demo offline.
yeah, no doubt. Moving right along to product tech stack. And this usually is a function of the company, like we could say vintage for lack of a different term, but like how old is the business?
Hmm.
The older, the more assumptions you can make around what the tech stack looks like, which then implies tech debt. It has implications around talent. Like how are we going to recruit developers that don't want to work in Latin because no one speaks Latin anymore.
Right.
So
Or
anyway,
with an
that's an obvious.
outdated like code base that they now have to revamp.
Totally. And as an acquirer too, like, man, it's crazy how many companies you're looking at. And it's like, hey, we're, halfway through, a third of the way through a whole platform refresh. And it's like, ooh, do I want to inherit the moving you from a 1990 Honda Accord to a 2020 Tesla while the car's moving? I don't know.
Probably not.
There's a lot of hair on that,
Yep.
All right. So now let's, on the bright side, quick wins and opportunities. So, and these are kind of in descending order of like how quick we could hit it. But so sales motion optimization. So it's pretty obvious from the website that this is sales-led growth. They're like, hey, human bespoke implementation, we'll guide you, we'll get you there. That again implies that the whole category is probably less along the tech maturity curve. So on average, people need a lot of hand holding. The thing that I noted was there wasn't a freemium or some kind of redacted or an offering that is just redacted functionality. It's like, cynically a gateway drug, right? Which is like,
Yeah.
hey, get in here and you can use this thing to just do rough estimates and send over a V1 bid. And to do that, it's significantly cheaper. Cool. Now you're up in our world. We have way more visibility into your usage, way more visibility into your org structure. Great. That facilitates a sales-led motion later on. And often this is referred to as kind of product qualified leads, PQLs. So you get them in the product using something very limited, and then that gives you way more surface area to measure and informs a much more pointed sales motion. And that's where I think my position on PLG versus SL, there was so much buzz around Enterprise 2.0. It was like Slack. All you got to do is get the user going, and then the user gets the team going, and then the team knocks down the whole business, and it's all product led. And it's like, yeah, in very nuanced use cases, is that available? I think for the vast majority, it's not a PLG or SLG. It's how do we sequence these? And at what stage do we layer in top down or do we layer in bottom up? Because both of these things are tactics that are available to us, and it's going to improve outcomes, and we want them to be ingrained and play nice.
And we touched on this in one of our earlier issues that we've recorded, and I like to refer to that process, that balancing act, as a value-led growth strategy because you have to know when to pull the lever on either.
Totally. And again, I think it's usually a function of sequencing. Start with one, and then once you got some momentum, figure out how you layer in the other, and then you should start to see some interesting outcomes there.
It's traditionally going to be starting with the PLG with the GTM, and that's going to inform the SLG. Yeah.
When I would say that that's probably the assumption in a modern context. Sure. In our racket at this scale, you should probably assume that sales led is what's in place, and you need to put your hat on around product led. And there's a ton of assumptions and things you need to vet around how the actual product functions, because product led growth don't work if the product ain't built for product led growth.
It's just if the product's not built for growth, it won't work.
It's like, dude, you can't just take this square thing and jam it in a circular hole. So cool. Moving right along. ICP expansion. So the thing that's interesting is countertop fabrication is so niche, but there are equally niche and directly adjacent segments like cabinets and just broader custom fabrication.
And flooring.
So I say ICP expansion here, but I'm not so sure that that's ICP implies a pretty strong departure from the customer profile that you're serving then. So, and I think in this one, this is almost like a segment expansion, but either way, with some fine tuning, I think you could open up way more of the addressable market and get after it. And then obviously geographic expansion, which is, pardon my French, fucking hard. So even if you're seeding new markets in English speaking countries, like, hey, cool. Yeah, we're going to launch an office in London. It's like, yeah, how hard can it be? It's like New York. It's like, oh boy, I've learned that lesson so hard. And then it's like, cool, let's go to Singapore. It's like, man, you got to seed these markets. You get a presence going. You have to establish a foothold with one or two customers. It's usually a customer success function, yada, yada, yada. And it's like, hey, we're going to launch a market a quarter. It's like, dude, you're probably going to launch a market a year. But anyway, that opportunity is available here. And then lastly, and I've been thinking way more about this lately in terms of like a huge component to a micro SaaS thesis is M&A and roll-up opportunities. And this was kind of what got my gears going around the operating concept teardown, because roll-up so much of private equity starts with a category. So like, let's just use COVID as an example. It was like, all right, we have a thematic thesis. COVID fundamentally changed the world. So what does that mean? That means people are going to spend more time working from home. That means people are going to spend more time working out from home. Okay, what does that mean? Let's go buy Peloton and let's go buy the company that sells standing desks and
Mm-hmm.
and then you kind of inform pointed targets based on a thematic view about the direction that the world is moving. Another thing you can think about is a roll-up strategy where it's like, hey, we're looking at this category. There are between 5 and 10 players. There's no obvious market leader. Let's go in and roll them up and own the market.
Yep.
So this category presented kind of an interesting thing. And you can start with a niche where it's like, this is niche as shit. What software vendors exist? Cool. Let's go grab one. This will be our platform. And then we'll grow inorganically. And what's interesting too, is to a certain degree with private equity, M&A is the only real growth lever. Right. And something that was very wise once put to me was that like, or I can't remember what the exact words, but it was like the best firms consolidate because they move up and they move up and they move up and they're elite. And then they consolidate because M&A and inorganic growth provides the best growth lever once you get to a certain scale. So said another way, to take a business from 5 to 10 million, you sell your brains out. To take it from 10 to 50, you have at least one acquisition on that road.
Yeah.
So
That
anyway,
makes total sense.
in this group, they had 2x direct competitors. And again, none were, and a proxy for this is something as simple as like the critical mass of Capterra reviews. And it's like, oh, this one has 200 Capterra reviews. This one has 400. This one has 300. Very different than this one has 100. This one has 200. And this one has 2,000. It's like, ooh, that group is probably spanking it. Quick wins and opportunities. That's a wrap. On we go.
On we go.
All right, market comps not available for ARRs at this threshold, and the weird part here, like I kind of grinded through this, I felt like a knucklehead, is the market comps are going to be based on the benchmarks that we use to come up with valuations. So I was like, this is a market comp basically. So we'll leave it at that. Okay, concluding thoughts. Bottom line is this is an actionable deal. Right. And I think there's a huge caveat to actionable. What does that mean? It means it's a vertical niche B2B SaaS firm that under very specific circumstances could be acquired. But that's it, right? Like there's no intent to sell here. And with that comes a whole bunch of assumptions, right? So I would say there's some play. Let me just think about how I kind of want to communicate this. So the first thing is that if there's no intent to sell, the actual process to make the acquisition is going to be totally drawn out because you have to communicate with them, gauge their interest, persuade them to explore an exit, and then they have to get their stuff together. They have to cobble together a data room. They have to get all these other things going, right? If we compare that to a business that has intent to sell, they're like, yes, I want to move now. I can sign this NDA. I'll get you into our data room later this afternoon. That's the pros. That's kind of one trade-off. The other bit is that if you're listing a company, there's a hardcore what's called selection bias. Put simply, why would somebody want to sell a business that's humming? So you can almost assume that if a business is for sale, something must be wrong.
Yeah.
Right. And you can call it selection bias, call it whatever you want. On the other side, if a business has intent to sell, it's likely that an auction could happen. Ooh, cool. Hey, I'm interested. And that drives valuations up. So it moves faster and the seller has their shit together. But on the other side of the coin, you're probably going to be paying a premium. For the off-market deals, they take longer to get going, but there's less likely to be an engineered auction. If an investment bank's involved, that's their whole job, is to basically engineer an auction. And so that's where value, you can kind of get in at a much more favorable valuation. So these are trade-offs. I think most of private equity, like what they would define as their edge, is probably around origination. And the whole thing is that, hey, we drum up proprietary off-market outbound deals, whatever terminology they use, because everybody else can take a flyer from an investment banker. Hey, and if you're selling a business and you have intent to sell, again, there's probably something wrong. And like ideally it's founder burnout. And they're like, hey, this is a great business. I'm shot. It's like, perfect. We'll take it to that next we'll steward it to the next tranche of growth. But if a bank is involved, there's going to be an auction, et cetera, et cetera. So concluding thoughts, this deal. Go ahead.
I was going to say I'd rather take founder burnout as the thing that's wrong than a situation like what would happen on a Billions episode, some crazy scandal that was forced upon them, and now like he has to sell. I'll still buy it, but man,
he's like, we're going to be bankrupt in a week. It's like, okay, well,
these folks. Like,
this is I guess a distressed kind of turnaround opportunity, but how much oxygen do we have here?
Right.
So in conclusion, this deal is not a fit for us. There's kind of a lot to be done with businesses that have intent to sell. So we're going to kind of take advantage of what's available in the marketplaces because those acquisitions move faster.
Yep.
Probably no matter what, you want to have outbound happening. So you want to have some working themes, working investment thesis about categories you're excited about, and then start to drum up some outbound. Just assume that it's a slower burn and it's going to take some time, but that the juice is going to be worth the squeeze. So it's like, hey, maybe it's 1 or 2 or 3 deals via listed businesses and marketplaces. And then in parallel with like the second or third, you start to spin up some outbound that's very data driven and very targeted based on categories or roll up opportunities or whatever the case may be. So this is kind of like the PLG SLG thing. It's like highly suggested. It's not either or, like we only buy listed businesses or we only go after outbound. It's probably a blend of both. And it's a function of how you sequence them and how you incorporate the next one as a function of maturity and where you're at.
Boom.
Boom. All right, y'all. I think that's like enjoy the shit out of your weekend. Much love. We'll catch you next week, which will be a highly related conversation around thesis.
now you have to do that on every call. That's
Yeah.
the thing now.
And honestly, I don't think I can pronounce it normally, so I got like a speech impediment that way. But
okay, as long as you don't end up on stage and do that.
Yeah, that's that one only is funny maybe once or twice. But well, Kjael, pleasure to share the field of battle with you, my friend, and I'll catch you next week. Go get on the rest of the day.
All right, you have a great weekend. Peace.
Happy birthday.
Oh yes.
Yeah.
Forgot about
All right,
that.
pal.
Yeah.
Peace.